Good morning. Welcome back to the final episode of Who Charted for 2025. I am Dan Russo, Co-CIO here at Potomac. Hope everybody's having a great holiday season. We're going to dive right into it. And the title of this week's note, as I wrote, is something that took me a long time to understand. New highs are bullish, right? Everybody wants to be a hero, make the hero call the top in the market, right? We go back, I touch on it in the note. You can go back through history. We remember all the great top calls, right? Paul Tudor Jones calling the crash of 87, Marty Zweig calling the crash of 87 2 days before it happened or 3 days before it happened. Meredith Whitney ahead of the financial crisis with a major downgrade call on all of the banks, right? These are people you remember. People who are bullish tend to not be remembered. But the simple fact of the matter is probabilistically markets drift up over time. Admittedly, I would have loved to have been one of those people at one point in my career to call a top in the market and be famous and be all over the TV. But honestly, it just doesn't make sense. Markets drift up over time. Being a perma bear or trying to call tops is a futile game. Also, the odds are not in your favor. Over time, new highs generally beget more new highs. And as we closed out last week, as we touched on in our previous recording, seasonality has been and remains strong. The trend remains up. And as we go to, as we often do, to the S&P 500 and the NASDAQ 100, both put in really strong showings last week with the S&P 500 closing on a weekly basis at a new all-time high. Now, the NASDAQ 100 is not there at an all-time high on the weekly basis. And honestly, that makes the move in the S&P 500 all the more impressive as far as I'm concerned, because everybody's caught up in the AI trade. Everybody's caught up in, is this a bubble, an AI bubble? Well, that generally tends to focus on the tech stocks in the market, heavily favored inside of the NASDAQ 100. So the fact that the NASDAQ 100 is not making new highs and the S&P 500 is making new highs, in my opinion, that is bullish because it shows that the theme is broader than just the AI trade or just the tech trade. Now, the transports, I guess there's some technology involved in transports, right? I would hate to think that there isn't as we get into planes and travel this time of year. But the simple fact of the matter is the transports are stodgy, and they have put in 5 consecutive weeks. 5 consecutive weeks where the close on Friday was greater than the opening or higher than the opening on Monday. As I've touched on numerous times in these videos, that is an indication that people want to take risk overnight. For us, the transports are an important intermarket theme. We look at the transports relative to their 27-week moving average. But the simple fact of the matter is you have weekly closing highs for the transports, weekly closing highs for the S&P 500. Now, for those who are into market history, this is our riff on Dow theory. Dow theory looked at the Dow Jones Industrial Average and the Dow Jones Transports. We look at the S&P and the transports. Doesn't matter what you look at. There's confirmation. Both are making new highs. All right. And there's breadth confirmation. This is a chart of the NYSE advanced decline volume line, right? We've said it before. We'll say it again. More volume trading in the stocks that are going up relative to the stocks that are going down is bullish. And if I were to write a textbook on technical analysis, this is legitimately the most perfect uptrend I've ever seen, notwithstanding my horrible line. Higher highs, higher lows is the textbook definition of an uptrend. This is actually trading at all-time highs, okay? Confirming what we're seeing in the S&P, likely leading the NASDAQ 100. It would not be surprising to see the NASDAQ 100 confirm and join the party, and also confirming what we're seeing in the transports. However, it's not just a U.S. story, okay? We've seen this chart numerous times. Global markets are here for the party this time, and we have not been able to say that for about 15 years. This is the MSCI ACWI ex-US ETF, and its 10-week moving average. And after that hammer candle last week that tested the rising 10-week moving average, we saw a powerful move last week. Opened near the low of the week, closed at the dead high of the week. Again, an indication that people want to go home on a weekend, a holiday weekend no less, with risk. And then finally, I will leave you with this. This is Europe. Europe has been left for dead by most investors. All right. The bear case on Europe is simple. There's not enough tech, especially if you're looking at Europe relative to the US, right? The US is tech heavy, 35 or 37% to the tech sector alone. And remember that does not include Amazon. That does not include Tesla. That does not include Meta and Google, right? Those are other sectors. Just the technology sector in the US, 37%. You start adding in those bigger names, you're probably closer to 50%. Europe doesn't have a behemoth tech bellwether. ASML is probably the closest thing you're going to get. So the big knock on Europe is not enough tech, right? Not enough juice in that market to keep up with the US. Well, Europe is trading at all-time highs as well. Right? Relative basis, we're not looking at that here now. Today's note is just to point out that it's not only the US market making all-time highs, right? We're seeing it globally. And in particular, one of the markets that's been left for dead, one of the markets that people said, you can't own that. There's not enough tech there. Well, guess what? If you've owned it, you're trading at an all-time high right now. So I am going to leave it there. I hope everybody has a happy and healthy new year. Thank you for coming back to the show and watching us every week. We truly appreciate it. We will be back next week with the first show of 2026. Have a happy and healthy, and we'll see you then.